Now it's time to welcome our special guest, Harry Dent, author of 0 Hour and editor of Economy and Markets newsletter, which is available for free at harrydent.com. Harry, thanks so much for being back with us right here on The Income Generation.
Yeah, nice to be back.
Harry, it's great to see you again. You are one of my favorite guests to have on our show, and we interview a lot of really big national iconic people in the financial space. But you and I and Dave both know that volatility is the greatest risk to folks that are over 60 today. So what should folks do at these new record all-time stock market peaks at this stage of the market cycle?
Well, in short, get defensive. We have seen the greatest short-term run volatility to the upside ever in history in the stock market since the COVID crisis hit and stocks crashed into March 2020. So that upside move means the next move is going to be very sharply, in fact, probably the sharpest we've seen in history, and very likely over the next few months is when this could happen. So you have to get defensive as quick as you can here. This is not something most people are going to see coming.
So define defensive, Harry. So when we say defensive, does that mean liquidating and getting out and going into cash? Or does that mean buying value stocks, which might be more buoyant if the market becomes turbulent?
No, this is an everything bubble. Everything crashes. Real estate, value stocks, growth stocks, any bonds that are not treasury bonds or AAA. It's a reset of all financial assets after the greatest financial asset bubble in history. And again, it includes real estate. So you get out of risky assets into the safest. So people say, oh, gold. No, gold has bubbled up just like stocks in recent decades. It is in the commodity complex, which is very volatile and has another big downturn to come. Gold will hold up better than most commodities, but the best safe haven is good old long-term treasury bonds of the US of A. Everybody says the dollar's going to crash. I'm sorry. I'm looking at 2008, which was a preview for this crisis deeper, and the US dollar went up and the US treasury bonds were the best safe haven. And you know what? The longer, the better. 30-year treasury bonds is what I'd be buying now, and I'd be getting out of stocks and real estate and higher risk bonds.
Or high-quality corporates. I would assume high-quality corporates are okay, too, if you're picking the right companies.
Quality in AAA. There aren't many of those, by the way, these days. So yes, but anything with risk on it. So bonds like the falling interest rates and inflation and deflation, but they don't like the rising default risk. So that's why you're right. Only the highest quality, AAA, AA, and then the 10 and 30-year treasuries, that's the place to be. Anything below that's going to see more default risk rising than benefit from the deflationary aspect.
So Harry, is this avoidable at all? I mean, can the Federal Reserve do something to stop this from happening eventually? I mean, they seem to be trying.
Yeah. Can the fox save the hen house? No. They created this bubble. The bubbles into 2007 were natural in that cycle. I call it the fall bubble boom season, like the roaring 20s. And yes, they got bubbly, but this is entirely on central banks around the world and the Fed. They did not allow the economy to deleverage and get rid of a lot of unproductive debt and zombie companies. We have 20% in rising zombie public companies. Forget small businesses failing at higher rates. So they didn't let the economy deleverage. So we're going to have a bigger downturn this time. They are the problem. Therefore, there's no way they're going to be the solution. If they just taper like they did, remember late 2018 where they just tapered a little bit? The repo crisis came right away, and they had to start printing money again faster than ever.
So time out, Dave, time out. Last show, Harry was calling a top of 4,700 on the S&P this year. So you want to revise that? You want to revise that, Harry? Are we going in a different direction now?
I think we could top, yes. I think we could top more at like 44, 4,500, and between now and late July. I would say late July at 4,500 would be my best forecast. In the short term, you're always looking at scenarios, and you can't predict the news and you know that sort of stuff. But that's what I'd say, that a little lower, 4,500, and maybe as soon as late July.
So if you're going to stay in growth, then essentially what you have to do is have one finger on the trigger, ready to pull that trigger when you see the momentum start to turn, right?
Well, yeah, and you can do two things. I've got this channel The easiest sell signal is if it breaks that channel around 4,100 ahead on the S&P 500, you sell there. But the better play is if we just get to the top of this channel one more time and what I call a fifth wave, I would tend to be selling at the top of the channel, or you could do both, sell at the top and then again at the bottom. But yes, you can't let this go too far. The most unique thing, I have tracked all the major bubbles in the last century and around the world, okay? The first crash of a bubble of this magnitude tends to be 45 to 50% in 2 to 3 months. And I have a megaphone pattern with higher highs and lower lows that more accurately projects about a 50% decline in stocks. Let's say you peak in late July. By September, October, we could be down 50%. This is not something to sit through in value stocks.
I know, and I know ultimately, last time we spoke, you even said perhaps as low as 1,500 ultimately on the S&P, which brings us back 21 years. So, Harry, unfortunately, we need to leave it.
Let me be clear. This is the first crash. The overall crash is likely to be, yes, down to 1,500 or lower over a couple of years.
Yeah. So, Harry, we need to leave it there for now. I hate to cut you off. You always have so many great things to say, but thanks so much for joining us. We appreciate it.